From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Softer U.S. growth. Business activity hits a speed bump on higher prices and supply constraints. Stock off their lows. We're going to speak to the man behind those numbers, Chris Williamson, IHS Markit Chief Business Economist. And it's definitely a turkey tantrum. The Lira free falls as President Erdogan re-ups his campaign to lower interest rates. Lira hit with its longest losing streaks in 20 years. And a crude reality. The market is underwhelmed by President Biden's decision to release 50 million barrels of oil from reserves, along with other consuming countries. From New York, I'm Alix Steel. My co-host in London, Guy Johnson, is here as well. Welcome to Bloomberg Markets. Guy, let's pivot off that last story. Oil prices up. Counterintuitive. Oil stocks, best performing sector on the S&P right now.
I don't think it's counterintuitive at all. It's exactly what everybody was expecting. Everybody knew that this was going to happen. It's been well telegraphed, as a result of which it's in the price. Now we've got it done. We can continue to see elevated prices. I think prices have been suppressed for a while because of the expectation this is going to happen. And we're going to talk about this throughout the show. Alex, maybe perversely what we need to see is higher oil prices so that U.S. oil companies start producing more oil.
Yeah, but a lot of the oil that's going to be released is in the swap market. So they're going to have to buy it back within the next few years. And you could argue that might actually depress the back end of the curve just a touch. That doesn't give the right kind of price incentive for U.S. producers to pump more oil. I also wonder if it sends a signal to U.S. producers there is a cap. There is going to be some kind of cap before this verbal intervention.
Maybe. I would be surprised if this is something that gets repeated. This feels like it has been shown not to work, and as a result of which the chances of it happening again, very unlikely to be repeated. I do think, though, that in some ways this is a genius trade, so that they're selling at 80 and buying at 60. This is quite smart trading, you could argue, from President Biden. We'll see whether it has an effect, but at the moment I am unconvinced. And I think a lot of people in the oil market are unconvinced.
It had the effect. Prices were off $8. Yeah, we're off that number, but it already happened. Like, it actually worked. Whether or not that's enough, that's a different story.
Yeah, but it's not going to hold. U.S. consumers are complaining at the prices they've just had, i.e. during the suppressed period. President Biden had a problem with gasoline prices over the last few weeks. He's now going to have an even bigger problem going forward. This hasn't solved anything, as far as I can tell, and the price action just speaks to that. Prices are higher today. Price pressures are a massive factor, Alex, in this economy. They continue to rise for both businesses here in Europe and in the United States. Economies on both sides of the Atlantic very much struggling to cope with these ongoing supply chain constraints and higher oil prices. You could see that in terms of the impact on inflation. The PMI data on both sides of the Atlantic really highlighting that. 15 minutes ago, we got the U.S. data. Let's dig into what we learned. Bloomberg's Mike McKee, over to you.
Well, Guy, following on what you said about the oil market, it is exactly kind of as you would expect in the services market for the United States. Manufacturing PMI, this is market, which is medium-sized, larger companies that export versus ISM, which is mostly really big companies. But the manufacturing number comes in higher, and we know that business has been good at manufacturers. Services, look at services. Services drop, and that pulls down the composite. So that sets us up for the question of what happens with the ISM when it comes out next week. Probably going to see it rise because manufacturing has been good. You can see here how both of these have gone up. They dipped a little bit, but you know, trees don't grow to the sky. The real question is what happens with services going forward, and you can explain what's happened there by the virus itself. The fact that people are not over the idea yet that they are a little bit nervous going out and trying to spend. We have shifted our spending. It was a service economy. Lately, it's been a manufacturing economy, and we've seen a lot more manufactured goods be on people's wish lists, and that has slowed manufacturing. Services, though, just kind of drops, and you can see here how much interest there is in services here. This is services spending versus goods spending. And until that starts to come up, until people start going out more often, we're not going to see the kind of services growth that our industries would like.
All right, Mike, great setup for us. Thank you very much. Bloomberg's Michael McKee joining us there. Let's get some more insight here on the PMI numbers. Chris Williamson, IHS Markit Chief Business Economist, joins us now. Chris, as Mike was just pointing out, this is not taking into account the recent rise in COVID cases in areas, particularly in the Midwest, potentially crimping what we see in terms of services growth. What do you expect?
It's the key thing to look out for, isn't it? Yeah, we're on the cusp of another wave potentially, which is going to hit that service sector. We've seen this in Europe. The numbers earlier today showed, especially in the euro area, where you've got a big rise in infections again, starting to really adversely affect sectors such as the tourism, recreation, consumer spending on services. That's likely to happen in the US if you get a further uptick in numbers. It's not going to be as bad as it was because the containment measures aren't needed to be as aggressive as they were earlier due to those higher vaccination rates. So they've got to be careful there about getting too depressed about how much you're going to see activity fall, but it will weaken. It looks like we've got a slower growth phase for the global economy coming our way. Now, at the moment, it's actually being driven by services. The charts you see there, a little bit comparing apples and pears, because your manufacturing PMI has a number of indicators in there, including suppliers' delivery times, which is really boosting that number up. If you look, for example, at the pure output numbers in the US, what have you got? Services 57, those 57.0 in November for that flash PMI. Manufacturing 53.9. It's a similar situation we're seeing in Europe, whereby services is actually driving the economies at the moment. Manufacturing is being hamstrung by still pretty much record supply constraints limiting those production capacities.
In terms of what COVID will do to that story, Chris, very nice to see you. Would we expect that a rise in COVID cases would make bottlenecks worse and therefore the inflationary components of what you're seeing in your data worse as well?
In many respects, yes. Because you've got two things going on. You've got bottlenecks due to those COVID restrictions. Think about, ports, where ports are congested. If you've got to introduce more sort of social distancing and measures like that, it's only going to aggravate those measures. And the second is, of course, this shift in spending from services to goods. So even greater demand for goods. We've got the holiday season coming up, of course, that's going to lead to a surge in spending. So it's only going to make that supply-demand imbalance even worse, which means more price pressures.
Let's talk a little bit about the Eurozone in a bit more detail. These are the November PMI data. Chris, you've kind of obviously worked your way through all of the various aspects to it. I want to focus, the numbers generally are very positive. We are seeing growth continuing to be very good, but we're also seeing super strong inflation, as you've already highlighted. What is the takeaway as to where Europe is right now from this data? And just focusing in on the UK as well in a bit more detail, we're seeing, again, strong growth and strong inflation. Does there need to be a monetary response off the back of this?
So certainly better than expected numbers, according to what most people are anticipating. Even things like the Bank of England, expecting a fourth quarter slowdown in the UK, probably not going to happen. We have the numbers rising up again, unless you get the Johnson government introducing some quite draconian lockdown measures in December. You're going to get a good month again for activity in the UK in December. So let's assume that we're going to get a good month. In the Eurozone, it's much more nuanced. We've got a good month in November, but the data, we collected those up to the 19th. And since then, we've got more worries about COVID infection rates coming through. It does look like you're going to get more restrictions implemented into December, which is going to mean the ECB is probably going to take a much more conservative view on the need for tapering. So you've got this, and this has been reflected in the FX markets recently, right? So you've got the Bank of England, you've got green lights for rate hikes from the Bank of England in terms of the price pressure gauges and solid economic growth. In the Euro area, it's much less clear cut. Yes, you've got these record price pressures, but the outlook is not quite so buoyant. Just take a look at, if you drill down into these numbers, Germany, where you've had quite a big rise in infection rates. In the service sector, inflows of new business there in December fell to near stagnation. They've been growing strongly earlier in the year. It's just all petered away as those COVID infection rates have hit demand for services. Now, that's possibly a harbinger to come for the rest of the region as these COVID waves spread through other countries. So I think the ECB is going to be looking at those more forward-looking indicators, things like inflows in new business, future expectations. They fell sharply in the euro area on these COVID waves. That suggests that you're going to get more weakness come through in the euro area, but perhaps less so in the UK and indeed the US.
So, Chris, last question here, but going forward, as we deal with these regional issues and targeted lockdowns, et cetera, and restrictions in Europe, less so in the US and the UK, what country do you feel is best positioned for continued sustainable growth in manufacturing and services? Where's the brightest spot?
Well, I think the US is pretty well placed at the moment. If it can get the port congestion sorted, then there are some indications that we're over the worst of those port congestions and the container issues. The US is pretty well placed. The UK has Brexit issues. The Eurozone is also hamstrung by this big wave that's not evident in the US at the moment. Now, the big bit of bright light really on the horizon that came through last month's PMIs was the upturn in production from Southeast Asia, which we'd seen output hit hard by the Delta wave. So now you've got Southeast Asia is the fastest growing manufacturing region in the world as it rebounds from those lockdowns, meaning that you're going to get more supplies coming through to the US, to Western Europe, if you can get your ports to deliver those goods to the final end user. So that's where the lockdown is at the moment. That's what we're going to be watching. If you're going to alleviate that, then US is looking good, more so than Europe, where you've got those COVID waves likely to hurt more so in coming months.
Chris, it's always a pleasure. Thank you for joining us. Chris Williamson, IHS Chief Business Economist. Coming up, tech erasing some of its earlier losses. Our next guest, watching valuations very carefully in this space. Cara Murphy, Kestra Holdings CIO, joining us next. This is Bloomberg. From London, I'm Guy Johnson, Alix Steel over in New York. This is Bloomberg Markets. Alex, let's talk about what's been happening with tech over the last 24 hours, maybe the next 24 hours as well. It's certainly been getting hit. The market is looking at what the Jay Powell renomination story means and figuring that we are heading towards higher rates. That is bad news for tech. Obviously, the tech sector has become increasingly narrow as well. It's a really interesting setup. Abigail Doolittle walking us through the moves.
Yeah, Guy, this is a super interesting story because at this time yesterday, not so long after that Powell announcement was made, we actually had tech up sharply, up more than 1%, the best sector on the day. But at the end of the day, down more than 1%. Big outflows. That's especially true for the QQQs or that tech ETF. $1.72 billion worth of outflows. The ultra short QQQs or highly leveraged, not as much. So perhaps those investors sticking with it, or maybe they're already out. We'll be taking a look at a chart in a moment that may suggest that. And then the Vanguard communication services, think Twitter, Google, Alphabet, those not as big of a decline. But still, overall, outflows yesterday on that Powell news and the idea that you are going to see a normalization of rates and that could pressure these high valuation stocks. But take a look at this to the point of higher quality tech taking the hit yesterday. That's because high quality tech has really largely been up and away. More recently, the less profitable tech shares have taken a sell off. So perhaps in some anticipation of yesterday. And then finally, in terms of the technicals, Alex, which you know I love for sure, we're taking a look here at the NASDAQ 100 and then the members above the 50-day moving average right now on the downside at 56%. Now, Alex, that's actually pretty high. Anything above 50% is good, but you can see the direction not great, and it could go down much more if the tech selling continues.
Yes, that was my chart from Friday. Thank you very much for validating me. Abigail Doolittle joining us from Bloomberg. All right, joining us now for more, Cara Murphy, Kestra Holdings Chief Investment Officer. Cara, let's just start right there with tech. Do you sell into the sell-off?
So I think that's a really great example of what we're paying very close attention to. Valuations is the one kind of fly in the ointment when it comes to the market. The market overall has really strong underpinnings, strong profit growth, free cash flow margins. But when you look at valuations, whether it's price to sales, price to book, price to long-term earnings, they're really at very high levels. But if you can look in pretty much any sector and find stocks that are still relatively attractively valued and still have that really strong free cash flow generation and balance sheet. And I think you're seeing that divergence within tech, where investors are still maybe liking the tech story, but are rotating into names that they can get a little bit more comfortable with.
But the market is becoming very tight during this phase, Cara, and we are leaning on more and more stocks. You get a dip in Apple, you're seeing a major effect. It was Amazon yesterday. The market feels like, as a result of which, it's looking more vulnerable as we make this switch and become tighter.
Well, certainly, Apple has been a big driver of the overall market. But, again, there are stocks like that have like really strong valuations. And I think there are other measures of the market where, you can see pretty good breadth, across different sectors. You see companies that have improved margins, improved free cash flow. So I don't think you have to be in the exact individual names in this market in order to win.
Yeah. Well, okay, but to that point, it feels like you're describing energy and financials at that moment. Are those the places that you want to be?
So energy is one of the few sectors that can do well consistently in a high inflation environment. So if you have a view that, inflation is going to stick around for a while, if you want to make a more medium-term bet, I think energy can be quite attractive and can be a really helpful hedge on inflation. The challenge with energy is that you have to get your timing right. If we are not in a sustained inflationary environment, or if we, sort of pass through that period, energy does not have a great track record of outperforming the market. So I think, in that case, you mentioned financials. That's another area where valuations have really lagged. You can still have a pretty good valuation story, even with flattening of the yield curve. You have credit improving. You could have loan reserve releases and a pickup in loan demand.
What is my inflation hedge in all of this? How do I balance out thinking about a positive economy, thinking about the growth narrative? We've just been hearing it about the PMIs here in Europe. Really strong growth numbers, good momentum, but at the same time, super strong inflation in that mix as well. How do I manage one with the other?
Yeah, and that's the tightrope that we have to walk as investors, right? Managing that, growth expectation with the fear of inflation eating into returns. And that's why we would favor investing in things like tips, bank loans, things that don't have the volatility associated with the energy sector and can have a more consistent return. But I think those are great tools for investors to be able to incorporate in their portfolio to better hedge themselves in an inflationary environment.
So where does that leave consumer stocks? We're showing right now a chart of Best Buy. I mean, a huge gap down, 15%. Margins got hit. There were obviously some idiosyncratic issues as well with Best Buy, but the margin story is something we saw with Target and with Walmart that kind of weighed on their overall rosy outlook. What do you do with those kind of names?
So I think, though, partly if we look through and we believe that inflation is transitory, then those prices that are, challenging those margins are going to abate over time. And then if you look at the end consumer, very strong wage picture, strong labor picture, a lot of cash in consumers' pockets. So I think longer term, that demand picture should really take those types of business models.
What I don't understand is the time frame, though. Over time, we are going to see this working its way through. Over time, we are going to see this inflation being transitory. The debate over transitory seems to have sort of changed quite significantly. In fact, I'm hearing that word less and less right now. I think there is a belief that inflation is going to be with us longer than we anticipated. Yes, at some point it may drop, but between now and then can actually be a fairly elongated period. How are you thinking about the duration of inflation right now?
Yeah, that's a great question, because I think for many of us, the idea of transitory went from like a quarter or two to a year and a half. And certainly these supply chain challenges are taking a lot longer to ease than we would have expected. But I actually think once we start to have inflation turn, it could turn quite rapidly. So think about all these folks who are anticipating supply chain challenges. So they might order multiples of a single product, hoping that one is going to come in time. So there's going to be a period where, the ports ease up, goods get on the trucks that they need to, and then we're going to find that there are a lot more goods sitting on shelves than we had expected. So I think that once we get through that turn is actually going to put a lot of downward pressure on prices.
That's such a good point, like a different kind of inventory build, really. Hey, Kara, before I let you go, there's going to be no doubt some volatility if that scenario winds up playing out. Also volatility to the end of the year. Where do you seek safety right now?
Safety. So again, I would pivot towards those names, and you can find these like throughout different sectors, names that have better valuation characteristics, strong free cash flow. And we talked a bit about the banks. I think that's a great place where you have a lot of those characteristics.
Kara, it's been great to catch up. Really useful insight into what is happening here. Kara Murphy of Kestra Holdings. Thank you very much indeed. This is Bloomberg.
Live from New York, I'm Alix Steel with Guy Johnson in London. This is a Bloomberg Markets. We are an hour into trading, and it feels a little bit like yesterday. NASDAQ now trading pretty heavy, down by 0.8%, dragging the under indices down as well. Dave Wilson is looking more at the stocks and sectors on the move. Hey, Dave.
Hey, Alex. You're definitely seeing some weakness among big tech, which would explain why, the information technology group and communications are lower in early trading. Of course, the big move of the day is really what we're seeing in the energy stocks. With the release of the Strategic Petroleum Reserve, 50 million barrels, coordinated with 5 other countries, you've actually seen oil move up. By some accounts, the reserve release was actually smaller than people were anticipating. And either way, you have the issue of, having to replace the crude that's taken out of the reserve, which will come down the line. Eventually, you figure U.S. companies would be among the beneficiaries of that. You're seeing that in the likes of ExxonMobil and Devon Energy. So the shale companies especially moving higher here. Retailing, really a mixed bag in today's trading because on the one hand, you've got Dollar Tree, which is in effect becoming $1.25 tree. They're moving the sort of base price for most of what they sell to $1.25 from that $1 mark, which gave the company its name. Now, on the other hand, you've got Best Buy down 15.5% after its results. Among other things, they're talking about theft at their stores. It just goes to show you how things are at this point with people coming back and with employees coming back too. Beyond that, you look at what's going on in financial stocks. We got another day of higher Treasury yields, and that's a plus for the banks, you figure, because they'll be able to make more money on their loans and investments down the line. We're seeing it show up in the financial index for the S&P 500 and the likes of JP Morgan Chase and Bank of America as well.
Dave, great stuff. Thank you very much. I guess the Dollar Tree Poundland model probably doesn't work quite so well if you want to stick to the letter of the law on the name of the company in a high inflationary environment. We've got smaller chocolate bars over here now as a result of it all. Dave, thanks very much indeed. Dave Wilson on what's happening in these markets. Let's talk a little bit about what's happening with the oil story. Dave highlighting what's happening with the oil stocks today. Oil is higher on the back of the release of the SPR, the US, China, Japan, India, South Korea, and even the UK deciding to release reserves today. Joining us now, Bloomberg Washington correspondent Amory Hordern, who broke the news about President Biden's decision yesterday. AMH, Alex and I are arguing about whether or not this worked, was a good idea. I just look at the price action. Yes, it's been suppressed for a while, but now that it's done, we move back up.
Yeah, move back up slightly. I have to say, Guy, I've been hearing your debate the entire morning, and I'm on Team Alex on this one. WTI just over a month ago was north of $85 a barrel, and we've seen over the past few weeks the United States have this verbal intervention. Washington verbally intervening in the oil market, and it worked. WTI prices are down, and now they are, they talked the talk, and now they're just putting their money where their mouth is, and they're saying we will tap into the SPR. Now, potentially it's not as big. You're seeing other modest consumers add some modest barrels to the market, more really politically a bold statement than I think it's going to really impact the price. So I think that's on one hand what some of this is. This has been talked about, and it was very much so baked in. That verbal intervention was baked in, And I think that verbal intervention worked. We can agree there. But the second thing, and potentially is why you see markets moving a little bit higher, is the ball now is in Riyadh's court, right? The IEF Secretary General Joe McGonigal said yesterday an SPR release potentially may move Saudi to want to ratchet back their production. So they're supposed to be producing every month. They're adding 400,000 barrels a day. Potentially, with consumers adding more barrels to the market, does OPEC Plus change course? But at the moment, there's no evidence for that. So that's pure speculation.
All right, Emery, great stuff. Team Alix, I dig that. Thank you very much, Emery Hordern, joining us from Bloomberg. All right, let's get more insight now. Damian Corvalin, Goldman Sachs head of energy research. Hey, Damian, you had a note out yesterday that said the market was already pricing in 100 million barrels of oil in terms of a reserve release. What is your response to what we saw from consuming countries and the corresponding price action?
Hi, Alex. So, as you just discussed, the announcement came smaller in size, in our view, than the market was pricing. Sure, more countries, but the details of the release are actually not that impressive. And so, our view was the market had priced in that, plus fear of European lockdown, plus fear of Chinese growth. So the release is a source of relief for prices, and we're rallying today.
Do we continue to rally, Damian, now that we've got this out of the way?
We think so, right? We think that the oil market is still in a structural deficit. We really haven't solved anything with $80 oil prices for the past 6 months. And so really the solution to the big deficits is OPEC initially, but it's really just higher prices driving more investment. That's what needed to really prevent significant spikes in prices in the future. Now, keep in mind, this is the end of the year. Liquidity is low. We have potential Iran headlines next Monday. So one should probably expect some volatility in the short term. But our thesis remains that oil are still not at the price they need to be to balance this market over time.
So to that point, because you're at 90, right? Price target?
Yes, 90 for year-end, yeah.
Okay, so 90 for year-end. And I'm wondering, though, what did we learn from this? It seems to me what we learned is that there is a consuming contingent of oil countries that want to intervene in the market if we get above 80. Does that continue? I mean, does that sort of change how you need to look at 90 or $100 oil?
Sure. So it is useful information to know that there could be, in fact, future intervention. When you look at the countries participating, they have more excess reserves than they need, and they've mentioned that they could do more. Again, those are transient sales. They're a one-off event. You could do it a few times, but that's about it. What we really need is aggregate supply to rise further to meet what is still relatively good oil demand, right? We're back to pre-COVID level. Growth in the global economy, international travel will push demand to record highs next year or the year after that. So we truly need that CapEx increase. That's really what we're solving for. What gets producers to spend more? And it's no longer 60-65, right? That was the early days of shale, where growth was rewarded for growth sale. Now we need actual good corporate returns. We need to overcome the headwind of ESG and outright demand uncertainty. And that just takes that higher price. And I think that's the real message for governments intervening today is, don't prevent that price signaling, because this is what helps fix the shortages in the future.
Where is that price? Where is that price point where discipline can be maintained, but output can increase?
Yeah, so we think it's 85, 90, but we're still looking out for exactly where that is. Look at shale producers. They're ramping up, but they're ramping up slowly. They're not yet at a point where they're able to deliver significant growth next year. And you listen to their guidance, they're quite cautious. They're cautious about OPEC. They're cautious about demand, future regulations. That to us so far means the risk could be to the upside. Now, of course, then there's Iran, right? Everyone's assuming Iran comes back next year. We've made that assumption. If Iran doesn't come back, we need a lot more investment. And then suddenly the price risk is above $90 for sure.
So we're just having a headline right now that says that Iran wants constructive engagement with the IAEA, to your point of will Iran or won't Iran come back to the market in full swing? What do you think the conversation is right now between Putin and Mohammed bin Salman?
I think from an OPEC perspective, their rationale hasn't changed, right? There were excess inventories that are normalizing. They have pricing power now, right? They can increase slowly without other producers like shale ramping up aggressively. That's the key difference from, say, 2015 to 19. So from their perspective, a cautious ramp up is still the way to go. Do they want to go ahead and offset the SPR release? I mean, all in, it's a $2 impact on prices. It's not that big a deal. That's more of a geopolitical discussion, probably not necessary. But I think the framework is there that OPEC has no incentive to increase production aggressively, and the SPR release probably comfort them in that reaction function, rather than suddenly force them to be very aggressive in ramping up. I think that definitely is not how they're interpreting this release.
Damien, people are getting in their cars this weekend. They're going to be driving. It's Thanksgiving over the next few days. Prices are a little lower, but not by much. You talk about the fact that we need to get to the point where we are starting to see investment, that we are starting to see new barrels flowing onto the market. But in the meantime, if we stay around these levels and the president continues to worry about inflation and it's hitting his polling numbers, what else can he do? Are there any other options? Is there a plan B?
So when you think about the tools at the disposal of the administration, they could do further SPR releases, right? So what we've estimated is this release is worth $2, so you could do more of those. There's a second pathway, which is your biofuel mandates. So, we have to blend ethanol in the US. That's stated by government mandates. Those volumes are flexible, and that contributes directly to gasoline retail prices. And so an easing of those requirements that are onerous to refiners, could be the second regulatory pathway to lowering gasoline prices. And the decision is expected soon. I think that's definitely the second pathway. The third one is, okay, we need more investment. So, that we've argued does take higher prices, but also takes some regulatory certainty, right? You have a lot of rules right now that are being discussed, whether it's methane, whether it's potential royalty, drilling permits. Some policy certainty is helpful, right? Investing under uncertainty is never comfortable and tends to delay investments. So providing a clearer framework for what are necessary, emissions and climate policies would eventually help as well. That's in the making, but still takes time.
Damien, really useful insight. Thank you very much indeed. Damien Courvallin of Goldman Sachs, greatly appreciated. The latest on the oil market, what comes next? I know a lot of Americans are now thinking about their Thanksgiving meal, but we're going to talk Turkey from a different angle. The Turkish lira in freefall after President Erdogan intensified his campaign for lower interest rates. The lira now on its longest losing streak against the dollar in 20 years. More on that next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Richard Haas, the Council on Foreign Relations President. 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First One News. I'm Ritika Gupta. China has pulled back on its already halting progress towards meeting its U.S. trade deal targets. Last month's purchases marked the slowest pace in a year. The agreement was signed in January of 2020. China's now reached just 56% of the two-year goal of $378 billion. The Biden administration has been pushing Beijing to live up to its commitments. In Turkey, President Erdogan vows to cut interest rates has sent the lira into a free fall. It's fallen below 12 per dollar for the first time ever, and in November alone, the lira has lost almost a third of its value. The latest plunge came after Erdogan defended his pursuit of lower interest rates to boost economic growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Ritika, thank you very much indeed. Let's carry on with that last conversation. The lira's slide. Bloomberg's Christina Aquino joining us now on set here in London. Some really brutal moves taking place here. My question is, how much longevity does this whole process have? How much lower could the lira go?
Yeah, well, Guy, that's the big question for every investor out there who is still invested in this market, right? How much lower can it go? Because it really does feel like the moves are accelerating. Even earlier today, we were tracking how long it took for the lira to go from those big levels, especially after it reached the 10 per dollar level. And it was shocking to see that. It was really quite astonishing that the time it took for the lira to go breach those levels is shrinking. And even today, it took one trading session for the lira to breach 12 and then go to 13. And that really is the pace of this decline at the moment.
Hey, Christine, if I was invested in Turkey, how would I still be invested in Turkey? What are the trading outlets right now?
Well, that's a big question, Alex, because I think, you know, a lot of foreign investors, we've definitely seen even years before what we're seeing now slowly exit the market, right? And so, but you do have foreign, or rather local investors still very much in the market. And, you know, I think the flip side of this Lira move, of course, we've seen some benefit to the stock market, for instance. We wrote about how we've seen the stocks there, particularly those who are export sensitive. You can imagine with a weaker currency, it's probably quite good news for them. So there are these silver linings that we're seeing, but you know, as far as kind of the currency is concerned, this is the pace of decline has really been the big news of the day, the big news of the last couple of weeks, and investors are very, very wary of what comes next and where the floor really is for the currency.
Any sign of contagion?
You know, at the moment, no. And that's very interesting because we were remarking just a few years ago, you may remember the last time that we saw such a pace in decline in the Lira. There is definitely signs that other emerging markets are getting sideswiped, but not necessarily this time around. I think what we're seeing generally in emerging markets is a lot of idiosyncratic stories at the moment. And of course, dollar strength, the overarching theme for all of that as well.
Hey, Christine, what's happening within the bond market in Turkey?
Well, you know, Alex, we're following kind of the same pattern that we're seeing in the currency markets. You know, we're seeing yields jumping quite a lot, even just today, following the move in the Lira as well. So bonds are definitely slumping along with the currency. We're also seeing some of the indicators of risk, such as the CDS measures, also indicating more risk there. And you can understand why, given the pace of the move in this particular currency, it definitely warranted here.
In terms of kind of what is happening on the ground as this takes place, as you say, the rate of change, the delta on this is absolutely huge. But are Turkish people, are Turkish banks, are Turkish businesses suffering as a result of it? You talk to people, they talk about the dollarization of the Turkish economy. Is this only going to accelerate as a result of what we're seeing here?
Yeah, I mean, that's certainly a big question, not just for traders, right, but definitely for people in the ground. Because if you think about it, you know, if you're just a person trying to do your grocery shopping, for instance, right, you're seeing the outsized effect of inflation on the price of your goods. And this is definitely something that you can imagine consumers, not just in Turkey, but all over the world, where we're seeing inflationary pressures right now. They're feeling this in their pockets. They're feeling this in their budgets. And, you know, Turkey is no exception. And so there's definitely that aspect of the story. And of course, just the idea of having a currency that is essentially in free fall, what that does to your external liabilities is another question that is worth asking, because we definitely see a lot of debt coming due, especially this month in November. This is debt both by external debt by corporates, by the government, and you got to wonder what that does to those liabilities there.
All right, Christine, thanks a lot. We really appreciate it. Christine Aquino from Bloomberg joining us there. All right, we're about an hour plus into trading session here in the U.S. Tech rolling over, now down by 1 full percentage point, dragging the S&P down 0.3%. Best Buy leading the way lower, though, for the S&P. We'll break down your trade. This is Bloomberg. All right, NASDAQ down 1%. U.S. equity stumbling about an hour and a half into trading. Steve Sosnick, Interactive Brokers chief strategist, joins us. What are we learning about today's market action? What's the trade?
Good morning, Alex. I think what we're learning is that yesterday's outside reversal, if that's what you want to, is one of the ways to look at it, was for real. I think yesterday it seemed like we were off to the races yet again, and then, that just sort of ended abruptly, in the morning and then in the afternoon by accelerating. And then what you see today was, whatever attempt there was to rally was pretty much squashed quickly. So it appears that the mood has shifted dramatically. Whether that's trading sentiment or investor sentiment remains to be seen. It's too quick to say that after a day and a half or less, but I would say this has been an interesting sentiment change, and I think the fact that it's happened after a record monthly expiry of options might be another clue to how much of the recent move was just driven by speculative options activity, in case that was in doubt.
Do you think those short-term traders buying calls, etc., are going to be back on Monday? This is a shortened week. I guess a lot of people have taken off already, maybe taking the whole week off. Can we park this week, or do you think, as you say, this week needs to be paid attention to?
I think some of each. I think you're not going to see them come back now. You know, one of the things that is required, though, a lot has been made about the move in options and how much, essentially how much leverage is involved when you buy stocks with calls. But ultimately, you still need the underlying stock to cooperate. You can't have a gamma squeeze without a delta squeeze first, or at least without delta participating, so to speak. And I think what you're getting now is taking a break. It is a lousy week to buy options, particularly if you buy weekly options, like many of these short-term traders do, because you're missing a day and a half. You're essentially paying for a day and a half of decay that you're not going to get. And I think they will stay away. Whether they come back, I certainly won't count them out, because every time they've been counted out before, they come back. Buy the dip has been a strategy that's worked.
Hey, Steve, what I am struck, though, is the move we've seen in real yields. On an intraday basis, we're looking at the highest level in the 10-year real yields since March of 2020. The last 2 days, we've seen a big reprice there. What is the feed through to volatility if real yields keep rising?
Well, I think the major volatility indexes are telling you that this is the time to start to be concerned about. Well, I think the time to have been concerned about it was before, but I think people are realizing maybe we should be more concerned about it. There's been a change. I think the markets are responding to the change in Fed policy. Whether or not you accept that stocks are the ultimate long duration asset, and how much you actually really believe that the NASDAQ move has been driven by volatility measures, by valuation measures, rather than momentum. We can leave that aside, but it's definitely a drag. The higher real interest rates reduce the TINA idea, and the idea that there is no alternative. And if we start to get the idea that there's alternatives, or at least that alternatives might be creeping in, it certainly weighs on a lot of these investment themes. And at the same time, a lot of the stay-at-home trade is not acting well despite the COVID fears in Europe. So it's a really tricky time that we're seeing right now of getting priced in.
Steve, thanks for your time today. Really appreciate it. Hope Thanksgiving goes well. Steve Sosnick, Interactive Brokers, greatly appreciated. Well, let's talk about some of those stay-at-home stocks, because we're coming into the European close. There's some interesting names out there, individual stock stories that are worth focusing on. Pets at home. So basically, you could park the Peloton and use it as a coat hanger, but you've still got to feed the dog, the new dog that you've got as a result of the lockdown. So Pets at Home continues to do well. Some really positive notes out there. Hennes and Mauritz, the company, the family's buying back into the company. That's being taken positively. But then you get to AO World. This is a white goods supplier. It's fridges, it's cookers, that kind of stuff. The supply chain story really hitting this company hard. We're down by 15%. Closes next.